Welcome to this lecture on the fallback rule found within Article 41 of the VAT Directive. Now, to understand the fallback rule, we need to understand the basic rule for goods moving from one member state to another. Here we have a UK company, VAT registered in the UK, selling goods to a French company registered in France. Now, under Article 32 of the VAT Directive, we have a place of supply in the UK, i.e. where the goods leave, where they're transported from. That's the place of supply. Now, the provisions for intra-community movement of goods is that, yes, it's a place of supply in the country of departure, but if you get the VAT number of your customer, so in this case the French VAT number, then the liability in the UK, in my example, is exempt with credit. In the UK, this is regarded as zero rated. Same thing, just different member states call it by a different name. But it's effectively no VAT due, but any related input tax is deductible. So that's the Article 32. In my example, a UK place of supply. And ultimately, the UK company does not charge UK VAT to that French company because they have their VAT number, the French VAT number, and in the UK, it's exempt with credit. Now, under Article 40, the place of intra-community acquisition of goods shall be deemed to be the place where the dispatch or transport of the goods to the person acquiring them ends. So what we have is an acquisition VAT liability in France. So the French company must account for French acquisition VAT, and it will just recover that same acquisition VAT as input tax, assuming, of course, it's a fully taxable company. If it was partially exempt, there'd be restrictions on the recovery, but there would be anyway if they bought locally. So what this acquisition VAT does, it tries to put the purchaser in the same position as if they'd bought from a local supplier. So Article 40, acquisition VAT is due in the country in which the goods end, i.e. France in my example. Let's specifically have a look at the fallback rule. So let's have a look at a situation where fallback will be relevant, and then we can understand the fallback rule. Now here we've got a UK company selling goods to a French registered company. Now that's the one we saw in the previous slide. But the difference here is that the goods don't go to France, the goods go to Germany. That's where the French company wants them. So we have an invoice going to the French co, but the goods go direct to Germany. Now if we look at the UK sale first, it's pretty much like we had before. We have an Article 32, place of supply, country of departure, and because we've got that French VAT number, we have this exempt with credit transaction in the UK. Now we saw on the previous slide that acquisition VAT is due in the country where the goods end up, i.e. Germany. So Article 40, VAT is due in Germany by French co. Now the Article 41 fallback rule will apply where you give a VAT number. So the French company has given a VAT number to the UK company. So under Article 41, because you've given a VAT number of a member state, i.e. France, then acquisition VAT is due in France. But it's also due in Germany, because Article 40 says that acquisition VAT under Article 40 is due where the goods end up. Article 41 acquisition VAT is the country in which you give the VAT number from. Now, the Article 41 acquisition VAT is cancelled out if Article 40 VAT is accounted for in Germany. So that Article 41 acquisition VAT won't be due if you can prove that you've accounted for acquisition VAT in another member state. Let's look at a case which shows why the fallback rule is important. In Facet Trading, an Italian company was selling goods to a Dutch company. But the Dutch company didn't want the goods going into Holland. The Dutch company wanted the goods to go to Spain. So the Italian company raised an invoice. The Dutch company gave their Dutch VAT number. The place of supply, Article 32, in Italy, country of departure. And because we've got that Dutch VAT number, the supply will be exempt with credit in Italy. So that part of the transaction's fine. So that's all done. Now the problem we've got here is that Article 41 acquisition VAT is due in Holland because they used a Dutch VAT number to secure that exempt with credit purchase. So Article 41 acquisition VAT is due in Holland, but they cannot get an offset because they did not have the evidence to prove that acquisition VAT had been accounted for by them in Spain under Article 40. So essentially Article 41 wasn't disapplied because they couldn't prove that it accounted for acquisition VAT under Article 40. Now the real problem for this is that acquisition VAT is due in Holland, but there is no offset for it. So it becomes a cost of the Dutch company. So this fallback provision, if you give a VAT number of a member state in which the goods don't go into, then you've got this Article 41 acquisition obligation with no offset, unless you can prove that Article 40 VAT has been accounted for by you in another member state. So the fallback provisions is all about Article 40 and 41. Article 40 would obviously be what we'd be looking to apply. Article 41 is really there for a bit of anti-avoidance in many respects. They don't want acquisition VAT to just disappear. So therefore, if you use a VAT number, then acquisition VAT is due in that member state unless you can prove that you've accounted for Article 40 acquisition VAT in the country where the goods go to.